Real estate investment strategies for beginners. Welcome to Journey Realty Group, where we unlock the secrets to financial success. In this video, we're delving into the realm of real estate investment, a dynamic world that offers tremendous opportunities for beginners. Intro. Rental properties. So, you're looking to begin your real estate investment journey with rental properties. Fantastic choice. Rental properties can be an excellent source of passive income and a steady stream of financial growth, but they do require a bit of groundwork. Let's explore this strategy in greater detail. Before diving in, it's crucial to become intimately familiar with your local real estate market. Why? Well, real estate is all about location, location, location. Start by researching your area, understanding the neighborhoods, and identifying trends. You want to find an area where property values have a track record of appreciating. Look at historical data, future developments, and the overall economic health of the region. When considering potential rental properties, evaluate factors like proximity to schools, shopping centers, public transportation, and job opportunities. These aspects are appealing to potential tenants and can help you maintain a consistent cash flow. Once you've pinpointed the right property, the next challenge is securing reliable tenants. It's not just about finding anyone willing to rent, it's about finding the right tenants. Conduct thorough background checks, including credit and rental history, and contact references. Screening tenants rigorously can help minimize the risk of non-payment or property damage. Additionally, setting clear expectations from the beginning can lead to a successful landlord-tenant relationship. Provide a comprehensive lease agreement that outlines rules, responsibilities, and expectations for both parties. This document serves as a crucial reference point and can prevent misunderstandings down the road. Now, let's talk about rental rates. To maximize your income, you need to set competitive rates. But how do you determine the perfect number? First, look at similar properties in your area. What are they charging for rent? This can give you a ballpark figure. Consider your property's unique features. Does it have extra amenities, like a backyard, swimming pool, or covered parking? If so, you might be able to charge a bit more. On the other hand, if your property has limitations, such as an older interior or a less favorable location, you might need to adjust the rate accordingly. Remember, it's a balance between being competitive and covering your costs while still making a profit. It's a good idea to periodically review the rental rates in your area to ensure you remain competitive and adjust as needed. Once your property is rented, effective property management becomes paramount. This involves promptly addressing maintenance and repair requests from tenants. A well-maintained property not only keeps tenants happy but also preserves the value of your investment. Stay on top of inspections to identify and address issues before they become major problems. Maintaining a positive relationship with your tenants is essential for renewals and, subsequently, a steady income stream. Rental properties can be a lucrative endeavor, but they require careful research, tenant selection, competitive rental rates, and effective management. By putting in the effort upfront and managing your property diligently, you can create a sustainable source of passive income and lay a solid foundation for your real estate investment journey. Remember, real estate investment is a long-term game, and making informed decisions from the start will set you up for success in the years to come. House flipping. House flipping, as you might have seen glamorized on reality TV, is a tantalizing prospect for real estate enthusiasts. The basic concept is enticing. Buy a rundown property, breathe new life into it through renovations, and then sell it for a tidy profit. However, let's get one thing straight. The path to success in the house flipping business is anything but a straight line. To truly thrive in this venture, it's imperative to dive into the details, especially in the context of the diverse and multifaceted U.S. real estate market. To embark on your house flipping journey, the very first step is locating the right property. In the vast expanse of the United States, real estate markets can fluctuate dramatically from one locale to another. Accurate property valuation is the bedrock of your project. You must develop an acute eye for identifying potential gems in the real estate market. Understanding the specific location and the nuances of the neighborhood is a crucial part of this process. Different regions will have unique preferences and varying price points. What's considered a steal in one city might not cut it in another. Therefore, you must become an investigator, unearthing the hidden gems in the market. This is where the real work begins in the house flipping game. With your property secured, the real excitement begins: renovations. However, this exhilaration is best enjoyed with a comprehensive renovation plan in hand. Tailoring your renovation efforts to suit the tastes of potential buyers in your chosen area is key. Are they looking for open floor plans, stylish countertops, or energy-efficient appliances? Knowing your target audience and giving them what they desire is the name of the game. Managing your budget is another fundamental aspect of renovation. In the USA, where real estate markets differ significantly, you need to be mindful of the financial side of things. Variations in local building codes and permit requirements can introduce complexities into your renovation process. Knowledge of these regulations is essential for ensuring your project progresses smoothly and that you avoid unforeseen expenses. Now, it's time to discuss the not-so-glamorous side of house flipping. Market fluctuations can play a significant role in the success of your venture. These fluctuations can impact your potential resale value, meaning you might be holding onto a property for a longer period than initially anticipated, which can eat into your potential profits. Budget overruns are another looming obstacle in the house flipping business. Renovations frequently unearth unexpected problems, from structural issues to plumbing nightmares. To mitigate these risks, a well-planned contingency fund within your budget is a prudent measure. Additionally, you must consider the tax implications within the diverse U.S. real estate market. House flipping may lead to capital gains taxes, and navigating this complex landscape is crucial to optimizing your profitability. House flipping in the United States is a thrilling and potentially lucrative venture. However, it's far from a straightforward path. In-depth comprehension of the local market, precise property valuation, methodical renovation planning, and a preparedness for potential pitfalls are the cornerstones of success in the multifaceted and dynamic U.S. real estate arena. Engaging in this adventure requires meticulous planning, an unwavering eye for detail, and the resilience to navigate the unexpected twists and turns along the way. So, if you're ready to embark on your house flipping journey, you're in for a ride filled with challenges and rewards. Real estate crowdfunding. Alright, let's step into the world of real estate crowdfunding. This investment strategy is a true game changer, especially for those of us with limited capital looking to tap into the lucrative real estate market in the USA. Real estate crowdfunding, in a nutshell, is like Kickstarter for property investments. It's a concept that brings together a multitude of investors, each contributing a small sum, to collectively fund real estate projects. The advent of digital platforms has made this method more accessible than ever before. In the United States, the history of crowdfunding is an interesting one. It became a prominent concept in the wake of the Jobs Act in 2012, which eased regulations around crowdfunding. This legislative shift opened the doors for both accredited and non-accredited investors to participate in real estate deals. These platforms work by offering investment opportunities in a variety of real estate projects, from residential to commercial properties and everything in between. The process typically involves browsing through a selection of deals, each with its unique details, financial projections, and risk factors. Investors can then choose which projects align with their financial goals and risk tolerance. One of the significant advantages of real estate crowdfunding is the ability to pool resources. Let's say you have a modest sum to invest, perhaps a few $1,000s. In the traditional real estate market, this amount might not get you very far. However, with crowdfunding, you can join forces with other investors who contribute their funds, and collectively, you can enter the world of real estate. There's a lot to like about real estate crowdfunding. Firstly, it's a more affordable entry point into the real estate market. Historically, real estate investments often required significant capital. Now, even individuals with limited resources can become real estate investors. Additionally, it offers diversification. Instead of putting all your eggs in one real estate basket, you can spread your investments across multiple properties and markets. This can help mitigate risk and maximize potential returns. Like any investment, real estate crowdfunding isn't without its challenges. It's a relatively new field, and as such, it can be less regulated compared to traditional real estate investing. Therefore, thorough due diligence is essential to ensure you choose a reputable platform. Liquidity can be another concern. Real estate investments are often long-term, and the ability to cash out your investments might be limited, depending on the platform's rules. Real estate crowdfunding has revolutionized real estate investment, making it accessible to a broader range of investors in the USA. Its history is intertwined with regulatory changes that have paved the way for everyday individuals to participate in real estate deals. By pooling resources, investors can embark on their real estate journey, enjoying the benefits of diversification and lower entry barriers. However, as with any investment, it's important to conduct thorough research, be aware of potential drawbacks, and select the right platform for your financial goals. It's a powerful tool in the modern investor's toolkit, offering a slice of the real estate pie to those who may have previously thought it was out of reach. Real estate investment trusts rights. When it comes to real estate investment, not everyone is eager to dive into the nitty-gritty details of property management and renovations. If you're looking for a more hands-off approach, real estate investment trusts rights might be the ideal solution. Let's journey into this intriguing investment avenue and explore what rights are all about, their inner workings, and why they're such a compelling choice, particularly in the context of the USA market. So, what exactly is a right? Think of it as a financial vehicle that allows you to invest in real estate without the need to buy and manage the physical properties yourself. It's like real estate mutual funds, but instead of investing in stocks, you're investing in properties. These trusts own, operate, or finance income-producing real estate in a variety of sectors, ranging from residential and commercial properties to infrastructure and healthcare facilities. In the United States, rights have a rich history dating back to the 1960s. The Wright Act of 1960 laid the groundwork for this investment vehicle. Since then, they've become a fundamental part of the real estate market. Rights offer a simplified way for investors to access real estate assets without the complexities of traditional property ownership. Rights operate under a simple yet powerful principle. They're required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. This financial structure essentially transforms them into high-yield investment instruments. As an investor, you're entitled to a portion of the rental income, profits from property sales, and any other earnings generated by the trust. Rights often come in various flavors, each specializing in different sectors of the real estate market. For example, you can find residential rights that primarily focus on apartment complexes or commercial rights that own and manage office buildings or shopping centers. By diversifying across these specialized trusts, you can tailor your investment to match your objectives and risk tolerance. There are several compelling reasons why rights have gained immense popularity. First and foremost, they offer liquidity. Unlike traditional real estate investments, which can be illiquid and tie up your capital for years, rights can be bought and sold like stocks. This liquidity provides a flexibility that's especially valuable in dynamic markets like the USA. Diversification is another significant advantage. By investing in rights, you can spread your risk across a range of properties, locations, and property types. This can help protect your investment from the ups and downs of individual property markets. Now, here's the kicker: how do you pick the right for your investment portfolio? It's a bit like choosing stocks. You'll need to consider factors like the track record of the right, its management team, the specific sector it focuses on, and, of course, its dividend history. A high dividend yield might be enticing, but it's important to examine whether it's sustainable. In the USA, you have a wide array of options to explore, from equity rights that own and operate income-producing real estate to mortgage rights that invest in mortgage-backed securities. Assessing your investment goals, risk tolerance, and the market environment will help guide your choice. REITs offer a remarkably accessible, flexible, and diversified way to invest in the real estate market, especially in the context of the ever-evolving USA real estate landscape. Their history is intertwined with the evolution of investment opportunities, providing a bridge between traditional property ownership and modern investment strategies. By understanding how they function and carefully selecting the right REITs for your portfolio, you can access the wealth-building potential of real estate without the complexities of direct property ownership. REITs have become a cornerstone in the world of real estate investment, and with the right choices, they can be an invaluable addition to your investment portfolio. Real estate market analysis. In the world of real estate investment, understanding your local market is akin to having a map before embarking on a journey. Whether you're considering residential properties in suburban neighborhoods or looking to dive into the bustling commercial sector, success begins with comprehensive market analysis. So, let's take a deep dive into the fascinating realm of real estate market analysis, with a particular focus on the diverse and ever-evolving U.S. real estate market. First things first, what is market analysis? It's the process of examining the dynamics of a real estate market to gain insights that can inform investment decisions. It's not about guesswork or gut feelings, it's a systematic approach to uncovering trends, opportunities, and risks. To understand the significance of market analysis, let's take a step back in time. The history of real estate market analysis in the USA is rich and deeply rooted in the evolution of the nation. From the post-World War II suburban boom to the rise of urban gentrification in recent decades, the U.S. real estate market has undergone substantial transformations. Historical trends have shaped the way real estate is developed, managed, and invested in. For example, the shift toward suburban living in the mid-20th century influenced the development of residential properties outside urban centers. In contrast, more recent trends have seen a resurgence of interest in urban living, transforming neglected neighborhoods into thriving real estate markets. Effective real estate market analysis involves examining various aspects of a given market. This includes studying economic indicators, such as employment rates and GDP growth, which can provide insights into the overall health of the market. You'll also delve into supply and demand dynamics. Are there plenty of available properties, or is there a shortage? Understanding this balance can help you gauge potential competition and property appreciation. Demographic factors play a pivotal role too. Are young professionals flocking to the area, or is it a hub for retirees? This knowledge can guide your investment decisions, ensuring your properties align with the preferences and needs of your potential tenants or buyers. Market analysis is all about tracking trends and recognizing opportunities. For instance, you might notice a surge in demand for office spaces in a particular city due to the growth of tech companies. Alternatively, a developing arts scene in an urban neighborhood could signal potential for residential property appreciation. In the USA, each region boasts its unique trends and opportunities. For example, the tech boom in Silicon Valley has driven demand for residential properties in the San Francisco Bay Area. In contrast, cities in the Midwest have witnessed urban revitalization projects, creating investment opportunities in formerly neglected neighborhoods. The ultimate goal of market analysis is to make informed decisions. By understanding your local market, you can strategize your investments to align with your financial goals. If you're looking for stable, long-term returns, you might focus on residential properties in established suburban areas. However, if you're seeking higher potential gains, you might explore commercial real estate in burgeoning urban centers. Real estate market analysis is the compass that can guide your investment journey through the vast and diverse landscape of the U.S. real estate market. Understanding the historical trends, economic indicators, supply and demand dynamics, and demographic factors is the key to recognizing opportunities and mitigating risks. Each region within the USA offers its unique set of opportunities, shaped by historical, economic, and demographic factors. By conducting thorough market analysis, you empower yourself to make informed, strategic investment decisions that align with your financial aspirations. Financing options. So, you've set your sights on a real estate investment, and you've meticulously analyzed your local market. Now, it's time to turn those plans into reality, and that often means exploring the vast landscape of financing options. Financing is the lifeblood of real estate investment, and understanding your choices is absolutely critical. Let's journey through the world of real estate financing, especially in the context of the ever-evolving U.S. real estate market. To truly appreciate the significance of financing in real estate, let's take a quick look at its historical context in the USA. Over the years, financing options have evolved in response to the changing needs and dynamics of the real estate market. In the mid-20th century, traditional mortgages became the primary source of financing for residential real estate. These long-term loans made it possible for millions of Americans to become homeowners. The U.S. government's involvement in the mortgage market, particularly through agencies like Fannie Mae and Freddie Mac, played a pivotal role in shaping these financing options. However, the real estate market is anything but static. In the wake of the 2008 financial crisis, traditional mortgage lending tightened up significantly. The crisis prompted the emergence of alternative financing solutions as banks became more risk-averse. This shift in lending practices gave rise to a broader spectrum of financing options, each catering to different needs and scenarios. Traditional mortgages are perhaps the most familiar form of real estate financing. They come in various flavors, including fixed-rate mortgages, adjustable-rate mortgages, ARMs, and government-backed loans like FHA and VA mortgages. The hallmark of traditional mortgages is their long-term nature, often spanning 15 to 30 years. These mortgages have been instrumental in making homeownership accessible to a wide range of Americans. They offer stability and predictability, as monthly payments remain constant for the life of the loan in the case of fixed-rate mortgages. Now, let's pivot to a more niche but invaluable financing option: hard money loans. These short-term loans are typically provided by private lenders or investors. Unlike traditional mortgages, hard money loans are characterized by their shorter terms, typically ranging from 6 months to a few years. Hard money loans serve a unique purpose. They're ideal for investors who need quick access to capital to fund real estate projects, particularly those that may not qualify for traditional financing due to the property's condition or other factors. However, the convenience of hard money loans often comes with higher interest rates and fees. In the dynamic world of real estate, creative financing strategies have also become increasingly popular. These can include techniques like seller financing, lease options, and even crowdfunding. Creative financing allows investors to structure deals in ways that cater to their specific goals and needs. For example, seller financing involves the property seller acting as the lender, which can be beneficial for both parties. Understanding your financing options is a pivotal part of your real estate investment strategy. It's not a one-size-fits-all situation. The financing you choose can significantly impact your investment returns, your ability to seize opportunities, and your overall risk exposure. In the USA, where the real estate market is incredibly diverse, with varying property types and investment objectives, having a deep knowledge of financing options is like having a versatile toolkit. Depending on whether you're looking to buy a family home, a rental property, or a commercial space, your financing needs and options can vary greatly. Real estate financing is the financial engine that propels your real estate investment journey. Understanding the historical context of financing trends, from traditional mortgages to hard money loans, is key to making informed choices in the ever-evolving U.S. real estate market. By exploring the various financing avenues and aligning them with your investment objectives, you're better equipped to navigate the dynamic world of real estate investment and optimize your financial outcomes. Whether you're a first-time homebuyer or a seasoned investor, the right financing choice can open doors and unlock the full potential of your real estate endeavors. Real estate investment risks and rewards. Real estate investment is often depicted as a path to financial freedom, and rightfully so. However, this journey is not without its challenges and intricacies. To become a successful real estate investor, one must tread carefully, understanding the potential risks while also recognizing the bountiful rewards. Let's embark on this journey through the lens of the ever-evolving U.S. real estate market, where trends and dynamics play a crucial role in shaping these risks and rewards. Understanding the risks and rewards of real estate investment necessitates a brief look back at history. The U.S. real estate market has experienced notable fluctuations, including the booms and busts of the late 20th century and the housing market crisis of 2008. These historical events have left lasting impressions on real estate investors, shaping their risk tolerance and strategic approaches. It's imperative to acknowledge the potential pitfalls in real estate investing. Market volatility can lead to fluctuations in property values, which can significantly impact an investor's return on investment. Economic downturns, such as the 2008 financial crisis, can result in property depreciation and financial hardships for investors. Additionally, the illiquidity of real estate assets means that your money can be tied up for an extended period, making it challenging to respond to urgent financial needs. Property management can also be a source of risk. Maintenance costs, dealing with difficult tenants, and unforeseen property issues can strain an investor's resources and patience. Lastly, financing risks, such as fluctuating interest rates, can affect the cost of your mortgage, potentially reducing your cash flow. Mitigating these risks is a crucial aspect of real estate investment. Conducting thorough market analysis, as discussed earlier, can help you identify markets with stable or appreciating property values. Diversification across property types and locations can spread risk and minimize the impact of market fluctuations. Effective property management can help reduce tenant issues and maintenance costs. Engaging a property management company or staying informed about property maintenance best practices can be valuable in this regard. Financing risks can be mitigated by considering long-term fixed-rate mortgages, which provide stability and predictability in interest expenses. Additionally, maintaining a contingency fund can help cover unexpected costs that may arise during property ownership. While there are risks, the rewards of real estate investment can be truly remarkable. Cash flow from rental properties can provide a consistent stream of income, particularly when your properties are occupied by reliable tenants. Over time, as you pay down your mortgage, your equity in the property grows. Appreciation is another key benefit. Historically, real estate has appreciated over the long term, often providing significant capital gains. This is especially true in markets with strong demand and limited supply, such as prime urban areas and thriving suburbs. Tax advantages are yet another layer of rewards in real estate investment. In the USA, tax benefits such as depreciation deductions and 1031 exchanges can help investors reduce their tax liabilities, allowing for more money to be reinvested or pocketed as profit. One of the most compelling aspects of real estate investment is its long-term potential. Over time, property values tend to appreciate, often outpacing inflation. This can provide a sense of security and financial growth that is attractive to long-term investors. Furthermore, rental income provides a consistent cash flow, which can support a comfortable retirement or supplement other sources of income. The ability to leverage your investments with mortgages also enhances your potential for long-term financial growth. Real estate investment offers both risks and rewards, intricately tied to the dynamics of the U.S. real estate market. Historical events have left their mark on the approach of investors, and mitigating risks is a key aspect of real estate success. However, the rewards, such as cash flow, appreciation, and tax advantages, are compelling reasons to venture into this realm. Real estate investment offers the potential for financial freedom, and with the right strategies and risk management, it can be a powerful path to wealth and security. Legal and tax considerations. As you delve deeper into the realm of real estate investment, there's a significant and often overlooked aspect to consider: the legal and tax considerations. In the intricate world of the U.S. real estate market, understanding the nuances of contracts, property laws, and tax implications is paramount. Let's embark on a journey to explore the intricate tapestry of legal and tax aspects in real estate investment. Understanding the legal and tax aspects of real estate investment often requires a glimpse into the past. The history of property laws and taxation in the USA has seen substantial shifts over the years, influencing the way investors navigate this intricate landscape. Property laws in the USA have their roots in English common law, which laid the groundwork for property rights and ownership. Over time, these principles have evolved to accommodate the complexities of modern real estate transactions, such as zoning regulations and property easements. When it comes to taxes, the history is equally fascinating. The USA has gone through periods of relatively low and high taxation, affecting the financial aspects of real estate investment. The tax code has seen numerous changes, including the introduction of tax incentives and deductions designed to promote real estate investment. Contracts are the cornerstone of real estate transactions. Understanding the language and terms of contracts is vital for investors. A purchase agreement, for example, outlines the terms of the sale, including the purchase price, deposit amount, and closing date. Rental agreements or leases define the rights and responsibilities of landlords and tenants. Property laws govern how real estate transactions occur, and these laws can vary from one jurisdiction to another. Zoning laws dictate how land and property can be used, which can impact your investment strategy. Property easements grant others the right to use or access your property, and understanding these legal nuances is crucial. Legal considerations also encompass property titles and deeds. A clear title ensures that the property is free of any encumbrances or disputes that could cloud your ownership. Tax implications are a significant aspect of real estate investment. The tax code in the USA contains provisions that can impact your financial outcome. Property taxes, for instance, are a local tax that varies by location and property type. These taxes fund public services and can be a considerable expense for property owners. Depreciation is a tax benefit that allows investors to deduct the cost of their property over time, reducing taxable income. 1031 exchanges, also known as like-kind exchanges, offer an opportunity to defer capital gains tax by reinvesting the proceeds from one property into another. Understanding tax implications is key to optimizing your real estate investment returns. An investor who is unaware of available deductions or exemptions may miss out on substantial tax benefits. The intersection of legal and tax considerations often involves structuring your real estate investments in ways that minimize your tax liability while adhering to the law. For example, you might consider forming a legal entity, such as a limited liability company (LLC), to protect your personal assets and enjoy certain tax advantages. Understanding the legal and tax aspects also plays a vital role in estate planning. Property inheritance, estate taxes, and trusts are elements that require careful consideration for investors seeking to pass on their real estate assets to the next generation. The legal and tax aspects of real estate investment are inextricably linked to the dynamic and ever-evolving U.S. real estate market. Historical shifts in property laws and tax codes have shaped the landscape of real estate investment. Contracts, property laws, and tax implications are fundamental components of real estate transactions. To succeed as an investor, it's essential to navigate this complex terrain with knowledge and expertise, ensuring that your investments are not only profitable but also compliant with the law. So yes, this is it. Real estate investment can be a powerful tool for building wealth, but it's essential to have a well-thought-out strategy. Whether you're interested in rental properties, house flipping, real estate crowdfunding, REITs, or any other method, remember that knowledge is your most valuable asset. So, take the time to learn, analyze, and make informed decisions as you embark on your journey in the world of real estate investment. Thank you for joining us, and be sure to subscribe for more insightful content on Journey Realty Group.